Hi everyone, thank you so much for joining me. Today we're talking all things condos and townhomes because if you've been shopping lately, you know HOAs are facing some big challenges from rising insurance costs to property maintenance to stricter lending requirements. So to help us break this down for you buyers out there, I'm excited to have Sarah Mars-Batuni from Premier Plus Lending with me today to discuss how we can tap into both traditional and non-traditional financing options to get your deal across the finish line. Sarah, thank you so much for being here with me today. Again, it's a pleasure to have you.
Thank you for having me.
Yeah, anytime. You and I do so much work together very closely, not just for the obvious buyer transactions. Certainly that makes a lot of sense. An agent with their buyer client and a lender working hand in hand. But also you work heavily with me on the listing side of things as well. And this piece is really important, especially for today's topic of condos and townhomes, because it has been a roller coaster out there in the last few years with regards to townhome and condo purchases, as you'll probably agree, and we'll delve into more of the details, especially in terms of like what I touched on in my intro, rising insurance costs, stricter lender requirements, now property maintenance issues with some laws that have come into play in California. I would love to paint a picture for our viewers today about what a listing agent can do to kind of get ahead of these issues that buyers are facing, and then what buyers can do. So like, let's back up a little bit. When I'm taking a listing on a condo or a townhome, one of the reasons my clients pay me is because they want me to be a detective, right? They want me to find out everything that I possibly can. And you are extremely helpful to me in this process because more often than not, purchases are going to be financed. So I'm there ordering HOA docs from the very beginning, and the docs will include things like the budget, the reserves, the CCNRs, and I send those over to you, right? I'm like, Sarah, hey, take a look at these for me, please, before we go to market, so that we will know if there are any issues that we need to be aware of. Right? Because you also cross-qualify buyers for me, and we'll talk about that in a little bit. So if you could, from your perspective, shed some light on when I send you those HOA docs, what is it that you're looking for? And what are some of those red flags, actually, that you are on the lookout for so that we could advise the seller accordingly even before we go to market?
So there are a few different things like we check right away, and if we have the documentation, it makes it easy. So thanks for actually ordering it ahead of time. It's such an immense help when it comes to loans. So when it comes to budget, we look at reserves specifically because most conventional programs require at least 10% reserves. So right away I check to see if they're going to meet this guideline or not. So if their budget is below 10%, then I advise you, Christina, now you need to look for buyers who are putting minimum 10% down because this document is going to be presented to the lender and they don't have enough reserves to meet the requirements. So that's one specific thing we look for. The other question I'll always ask you is, are there any litigations? And if there are litigation, what is the type of litigation? Does the management company have all the proper documentation regarding this litigation? So some litigations are okay and some are not. And, we could go into the details of those. So that's something we right away try to identify. Homeowners insurance. So when it comes to condos, there's two different policies. There's what's called the master insurance policy, which is for the entire building of the condo. And then there's HO6 coverage, which is they also call it walls-in coverage, which covers anything interior. Typically, HO6 policy, whoever's purchasing the house will obtain that, and that's not an issue. But we look at the master insurance policy to make sure they have what's called 100% replacement cost versus cash value.
And that's where we've been having a lot of problems lately in the last several years with regards to insurance coverage with costs going up. We have been finding more and more that the coverage is just insufficient. So shed a little bit more light on that, if you will.
So with insurance, conventional or traditional financing require 100% replacement cost. What does that mean? It means if your roof were to burn down, the insurance is going to give you enough money to replace the entire roof. Because of the California wildfires and the cost of insurance going up, some of the management or HOA companies, to save money for the homeowners, they opt out to take a policy that has what's called cash value. And the cash value policy takes into consideration depreciation. So if a roof today costs, $50,000, and if you depreciate that, it used to be like $20,000, that's the cash value you're going to get for the roof. So it doesn't pay for the entire replacement of it. That's the main difference between the two policies. And traditional financing require 100% replacement cost. Sometimes when you get the policy itself, it'll state on there it's 100% replacement cost policy, and sometimes it doesn't, and you have to kind of ask the insurance agent to provide additional documents to verify this information.
Well, and so thank you for specifying the difference between the two, because it is a big difference. If something's going to actually cost $50,000, but you're going to only get $20,000 for it, the question then becomes, okay, who's going to pay
Absolutely.
the difference of that $30,000? It's going to fall onto the homeowners, right?
Absolutely.
So that's when we see some special assessments being
Exactly.
charged to the homeowners within that association on top of their regular HOA dues. So all of these costs kind of add up. Now, these special assessments have a start and end date. They don't go on forever and ever, but I've seen some that could go on for several years.
Yeah.
Depending on what what the issue was and what the costs are and how it's broken down among the different homeowners.
Yes.
And all these kind of come into play when you're pre-approving or qualifying a buyer. The HOA, any special assessments, their debt, their income, their credit, all of that comes into play in the underwriting that you're doing, because you want to make sure that this buyer can afford what they're getting into.
Yeah.
Correct.
So some of the things we could detect ahead of time, as a listing agent, you get certain documents, but some of the things we can't obtain it until you're in contract. So typically, once you're working with the buyer, we have to obtain something called HOA questionnaire. It's a list of questions that we send it to the management or HOA company, and they fill it out. Most of them are yes or no questions, and some of these questions may come up as an issue later, depending on how they answered these questions.
Can you shed some light on what some of these questions are? Because let's start there. Shed some light as to what some of these questions on that questionnaire are.
Some of these questionnaires are 100 questions. There's a lot of questions, but the key questions that we're looking for is what's the occupancy versus non-occupancy ratio, meaning like how many people in the building are actually occupying it as their primary home versus a rental property. Mm-hmm. It's required to be at least 51% to be owner occupied. Also, we're looking to see what percentage of people in the building, what's their ownership percentage in the building. Traditional financing, they don't allow more than 20%. So if one person owns like 10 units in a 20-unit building, that's an issue, because the risk is too high in case this person were to default or something happens, then the entire building's at risk. If, let's say, someone's purchasing a property in downtown LA and it has commercial space on the first floor or maybe first couple of floors, they want to make sure it's no more than 35% of the occupancy is commercial. So these are some of the questions that are on the questionnaire. The new thing that's recently has been a challenge is there was a law that passed which requires old condos starting January 2025 to inspect by an engineer or architect for any elevated areas such as balconies, staircases,
Decks.
yes. So that's also one of the questions on the questionnaire. So the question asks if you've had this inspection done, and if they say yes, and then typically it has like a secondary follow-up question to that, is were there any maintenance issues with this report? And if the management company answers that yes, guess what? They're going to ask for that report and analyze that report thoroughly to see what are the maintenance issues with elevated areas to make sure there's nothing hazardous within that report.
Right. I was chuckling earlier when you mentioned the questionnaire because I know that lenders send out questionnaires, so I kind of created my own questionnaire based on the lender's questionnaire. Now, my questionnaire is not 100 questions. I think it's closer to like 17 or 18 questions that as a listing agent, I email the HOA manager. Sometimes they're super cooperative and they're like, yes, no, yes, no. Other times, I just get blocked right away and they're like, we'll fill that out once we get the questionnaire from the lender. And I'm like, no, please fill out my questionnaire now because at least it'll give us some idea of just like the big red flags, like not the nitty gritty stuff, because each lender has their own requirements.
Yes.
They have different appetites for risk depending on whether they're a traditional lender versus a non-traditional lender, which is something that we'll end up talking about today. But that's why I started laughing when you mentioned the HOA questionnaire, because it was like, why do I need to wait until we're in escrow? Why can't we just get some of this stuff out of the way? But you win some, you lose some. I don't always get the answers that I need, but at least I'm trying, What you shared is about this questionnaire is a really great segue into now representing buyers. As a listing agent, I take it upon myself as a fiduciary to be that detective for my clients, to be proactive so that we can get ahead of any problems before they become problems. That's great. There are issues with the HOA. At least I know what they are, and I could advise buyers agents, hey, your client's got to put at least 20% down. Or there's litigation of this sort, just FYI. Or you can't go conventional. We've got to go non-QM financing. But when you're representing a buyer, which I do often, when I'm doing these buyer consultations, and you've sat down in some of my buyer consultations with me, you know how detailed they are, because just like I'm trying to get ahead of any potential issues with my seller clients, I do the same for my buyer clients. And when I know that they're in the price point of condos or townhomes here in LA, I tell them, look, strap in, buckle up. It could be a wild ride because you kind of don't know what we're going to be faced with.
Absolutely.
Each condo complex or townhome complex is different. Mm-hmm. They have their different issues. Each management company is a little bit different. They're more or less cooperative and easy to get a hold of. Each listing agent is different. Some are very proactive and try to get a handle on these HOA docs and packages and issues up front. Others have no idea. And it's like, okay, let's do all of this work. Let's write our offer. Let's get it accepted, negotiated, open escrow. And then, like I said, buckle up and just get ready for the ride, because this just becomes experimental at this point in time. I try also to get on the phone with the HOA office before I write the offer to try to get as much information as I can. But the problem we run into often is that HOAs and their staff won't share information with a non-owner.
Absolutely.
So those are some issues that we run into, but you still have to try. You don't ask, you don't get. So I always try, and I've had some success.
And you do an amazing job just being very due diligent. It really helps to get the transaction closed as quickly as possible.
Thank you. I'm anal retentive, I think, is the technical term. So thank you. I appreciate that. So in addition to, trying to find out as much as we can about the HOA, doing our diligence and you doing your diligence, qualifying the buyer, really getting down into their finances. And this is not like a back of the napkin, quick pen and paper, assessment of what they can do. Like you ask for documentation, tax returns, pay stubs, employment history, all that kind of stuff to make sure that we are positioning the client for success in this upcoming transaction. Like we're hoping and preparing for the best. And also knowing that if the worst happens, we have options, right?
We always have plan B.
We always have plan B and C and and D, and we've had we've had to use them sometimes.
Yeah, we've pivoted.
We have, and I think that really speaks to the importance of really being prepared and understanding the client and also like the nature of things with HOAs right now. So let's go into the scenario of, yay, congratulations, buyer. We have opened escrow and we're just sitting here with bated breath waiting for the HOA docs to come in. It is one of the more stressful times for buyers because they're kind of on a high right now, right? Like we've been looking for a property, we finally found one, we negotiated, and now it's like, okay, now it's ours. Now we're doing due diligence, physical inspections, etc., HOA docs. We have filled out, or not we, but the HOA rather, has filled out the questionnaire, and now some of the red flags start popping up, okay? The buyer who thought was going to be using conventional financing has now, it has now become clear that conventional financing, traditional financing, is not going to be possible for various reasons, okay? So now it's been determined this is not going to be your straightforward loan. We need to go non-traditional.
I think a lot of times, like, agents or clients hear the term non-warrantable condo and they're like, what does that really mean? And basically not meeting the requirements of Fannie Mae, Freddie Mac guidelines, which is what we just talked about earlier today. So non-traditional financing are like lenders, banks who go outside of the scope of the norm for any of those reasons. So it could be because of the insurance, it could be because of the percentage of occupancy, it could be because of the litigation, and tackling litigation. With litigation, typically what lenders look for is if it's some kind of a structural litigation to the building, it's probably not going to meet non-warrantable requirements either because they're deeming this as non-safe property. However, if let's say someone in the building tripped, hurt their head, and now is suing the HOA for monetary reasons, what the lenders typically look for is insurance. If the insurance coverage is enough to cover the litigation amount, or like what the amount they're suing for, then most likely you would be able to get financing. So it depends on the type of litigation on the property. But let's say if it's outside of the scope of what conventional financing, it's anything outside of that would fall under the non-warrantable condo. So for any of those reasons.
Great. Okay. Now I have with me this sheet. I came into the office one day and I saw this on my desk and I looked at it and I think I called you and I said, Sarah, let's book the studio. We're doing a video on this because it's really so important. So I'm just going to be referring to this sheet here. So when we're talking about traditional financing versus non-traditional or non-warrantable financing. So these are the factors. I'm just going to go down this list. Feel free to comment on each of these and maybe shed some more light on each one. Here it says non-warrantable factors. Over 50% of the units are investor-owned or rented.
So the requirement is that it has to be 51% or higher owner-occupied. So anything outside of that is going to fall under the non-warrantable realm.
Great. Okay. Here it also says one person, company, or investor owns 20% or more of the units.
Yeah. It's kind of like the example I used. If it's a 20-unit building and one person owns 10 of the units, that's 50% ownership. The max would be no more than 20%.
So if it was a 10-unit building and somebody owned 2 units,
Yeah.
That's 20%.
Yeah.
That would make it fall from the traditional into the non-traditional,
Absolutely.
non-warrantable. Okay.
Absolutely.
Another one here, it says, and I don't think we touched on this earlier, it says 15% or more of the owners are behind on their HOA dues, so HOA delinquencies.
Yeah, during the 2008 market crash, a lot of people weren't paying their HOA dues, and a lot of people were in default. We don't see this very often nowadays because most people are making their HOA payments. Once in a while, you see like one person in the like 100 person building who's maybe behind. So it's not very common that this is an issue, but it can be an issue.
Yeah, and they do look at it. It is one of the
Absolutely.
questions, right?
Yeah.
It's also in my questionnaire, but let's see,
You can
HOA.
take this one off.
I will. I'll make it shorter and sweeter for the
Yes.
HOA manager. HOA is involved in litigation. You just touched on that. So, I think it is important. We can't just lump litigation into one category because it kind of does fall into two different categories, really.
Yeah.
One is more like a liability, personal injury, and if there is enough insurance coverage, then lenders would be willing to overlook that. But when you say structural, like let's say sometimes this happens like in new construction, right before
Absolutely.
that statute of limitations runs out.
Yeah.
Water leaks, structural issues, homeowners end up suing the builder.
Yeah. And when they're in this type of litigation, even under non-warrantable, you may run into issues because it could be structural issue that could put everyone's at risk, and lenders just don't want to participate in that.
Sure, well, because lenders are usually taking the bulk of the risk anyway with the amount of
Yeah.
money that they're lending.
I mean, we had a situation, I think it was you and I a while ago, where there was also like neglect from the management company when someone complained about like rain leaked, and then they didn't replace the drywall, it turned into mold, and then it became like a health and safety issue. So these are some of the other, so like the homeowner was issuing the management company for neglect. These are some of the common types of litigations we see, and sometimes it's not necessarily a type of litigation. Also, let's say if they're suing the management company and there's a neglect from the management company, they want to switch management companies. So when they switch management companies, the new company sometimes just doesn't have the proper documentation. So not having lack of documents to understand what the litigation is, the underwriters can't make a decision, and based on that they might decline the loan, or we may have to pivot to a different type of program.
Got it. Okay. Very helpful. We have here also 35% or more of the property is used for commercial purposes. You gave that example. We don't see that so much like in the Valley, for example, but downtown LA, West Side, we'll certainly find that we'll have ground floor retail with residential up top. So the limit is 35%. Now,
That's one of the questions.
That is one of the questions on the questionnaire. Another one here, the condo is newly built and under 50% of the units are sold or occupied. So we're talking in situations that it's a completely new build from a developer, and they usually have the sales office on site and they're trying to sell the units.
With a lot of the new development condos, we could actually get the building approved ahead of time, so this doesn't become an issue. There's a process the builder has to go through with the lender, and then even if it doesn't meet this requirement, we could still do, because it's a brand new building, they have to sell one to be able to sell 2 or 3 or 4.
Sure.
So then the builder himself goes through this extensive process. Once the building is approved by a lender, then we could start doing loans in this building. And sometimes that's why builders choose a lender to work with, because they've already gone through that process.
Okay, I'm glad you brought that up, because I was going to ask about that. I've sold a lot of new construction, and it's just like that. You walk into the sales office, you get the information, and they offer you financing from their preferred lender. So the reason they're able to do that is because they've already gone through this process. Now, what buyers may not realize is that nobody can force them to use a particular lender, right? So oftentimes, if the buyer doesn't have an agent or an advocate informing them that, hey, this is just it's an option for you. It's not a requirement that you use this lender in order to buy a unit in this building. But it certainly helps that the builder has done their diligence and has already just kind of like done the legwork to know that, hey, we will, assuming that the buyer qualifies, we know that the building has.
Yes.
Right?
Yes. Yeah.
Yeah, because in these situations, the buyer has to qualify and also the building, which is why this questionnaire is so important. And then the last one over here, the condo allows short-term rentals like Airbnbs or VRBO. So this is also a no-go.
No-go, not under conventional guidelines. They don't allow this, but some of the non-warrantable lenders will allow this.
Okay. This is super helpful because it is very much a reality of the times right now. And I'm thinking back on a closing we did recently where there was a lot of pivoting going on, because even when it comes to non-traditional lenders, these requirements are not all the same. I think in that one case that I was talking about, that we had referenced earlier, we knew from the beginning that we had to go with a non-traditional lender. So we did, but then it was a particular issue with the building that they had a problem with. So then we had to go to another lender who didn't take issue with that building problem, but they took issue with something else that the first lender didn't have a problem with. So how many times did we have to swap?
Like at least 2 times before we were able to close.
But yeah, exactly. That's why it's so important. Like, we need to do our diligence. And also, I think that the hopeful thing that I would like our viewers to take away from today is that if there is a will, there is a way. I know, like, that's your personal tagline, and I think it's so great because it can be tough out there, and it doesn't have to be that tough if you're prepared, as a listing agent, if you do what you should be doing in advance for the benefit of your seller and for the buyer. Same thing when you're on the buy side, preparing your client for what to expect, being aligned with an amazing lender who is nimble and flexible and does a lot of legwork up front. So, when there is a will, there is a way. So, is there anything that I'm checking over here, and we just talked about some of this other stuff. You gave some great tips. Review HOA docs early, partner with an experienced loan officer, communicate financing implications early with sellers and buyers. It's everything that we talked about. It's not to say that there won't be bumps in the road, but they can be handled gracefully and quickly with minimal emotional roller coaster.
Yeah, I think just being due diligence as you've always been and communicating with your lender, hey, these are the documents I've gone, can you take a look at it, see if you see any red flags. And obviously we can't detect everything up front at that point, but at least we could look at the insurance up front. That's something that we could determine if they have 100% replacement cost or not right away. We can look at the budget right away as soon as you get that to see if they have 10% or not. So these are 2 things you could literally, or the litigation question by just calling the management company and finding out what type of litigation. Do they have all the court documents that describes the litigation? Because those are all the documents. When the questionnaire goes and they answer yes, then we're going to need follow-up documents. And you already have this. It just saves us so much time. And sometimes, like agents or clients complain, why does this stuff come up last minute? Well, because they weren't ordered, in advance. We're ordering it as we go. And some of these documents cost money. Management companies don't just hand them out for free. So like the seller would have to pay a certain dollar amount to get the CCNRs and all these documents. The buyer has to pay for the questionnaire. So if someone's not in escrow, they don't want to pay that fee to get those questions answered in advance. And sometimes, typically, like if HOA companies have a rush fee to get these documents to us sooner than later, I will always opt out for that just because it could save time in finding out if there's an issue or not sooner than later. And if the client wants to back out of the deal for whatever reason, they have the option to do it within their contingency timelines. So I think those questions, and then once we do get into escrow, I think the biggest challenge we faced recently specifically is the SB 326 report, which
With
is
the balcony.
which is the elevation with the balcony and decks and staircases. And one of the questions that came up, you and I had this situation, we were able again to pivot and find a solution, but we had a client who was buying a condo, and one of the balconies, the railing was loose. And when we went to the management company, and that report was from like a few years ago, so when we went to the management company, we said, hasn't this been fixed? This report's from 3 years ago. And the management company said that we just took over this building. So we have no record if this has been fixed or not. And we had to wait for them to re-inspect it and give us the clearance that that balcony indeed was fixed.
Yeah. So to that point, it doesn't even have to be the balcony of the unit in question in escrow. It could be any balcony in the building. It could be in the complex. It could be in a different building within the complex, but it still affects the subject property.
Absolutely.
That's in
and
escrow.
someone might say, why, if it's not our subject property? Well, it's a liability issue. Because if someone were to fall and die in the premises, they would sue the management company for neglect. Now it affects everyone in the building. So it's more of a liability issue than anything else, even though it's not the subject property.
Yeah, that makes sense. Can you touch on a little bit the differences that a buyer can expect if they're going the traditional route versus the non-traditional route? Are there differences in down payment options, perhaps the interest rate, anything like that?
Yeah, obviously with conventional traditional financing, you could do as low as 5%, if you're a first-time buyer, 3%. And typically the interest rates are not significantly better, but they're definitely more favorable. With non-traditional financing, you typically need at least 10% down or higher, and the rates are definitely a little bit higher just because banks operate from a risk point of view. They're like, if we're taking on a riskier property we want to charge a premium for that.
So I think that's so important that you brought up the key differences between traditional financing and non-traditional financing, because yes, while there is a will, there is a way, there is a certain cost that comes with, and it's really, really important that buyers know this up front, because one of the key cornerstones of my business that I operate from is my clients really need to know everything possible so they could make informed decisions. We've had clients when we've sat down with them to do their buyer broker consultations. We tell them about the two options, we do the math, and some of them decide to go for the non-traditional financing. They love that particular building. They're prepared to pay a higher down payment. They're prepared to pay a higher interest rate because that's what they want and it works for them. And there are others who have said, I'd rather stick with the traditional financing. I would rather be within a certain comfort zone in terms of financing than be in a building that's going to make me stretch and get stressed out about my monthly mortgage, so on and so forth. Yeah. So, I think it's really important that we guide our clients so that we can provide them with a proper solution, so that ultimately it's just very empowering for the client to know that they're the one in the driver's seat and we're helping them get there.
Yeah, absolutely. Yeah. And this is one of the reasons I love working with you, because you do all the due diligence up front. I don't think we've ever had a deal where we can get the client to the finish line just because we've done the homework, we've done everything we can to prepare the seller or a buyer in a transaction. And some of the things you've talked to them about is the sellability of the building in the future, and is this, if it's a short-term investment for someone, that's an important conversation that you have with your clients. If this is the stepping stone to buy a bigger, better house in the future. So I think those are the you cover so much in your consultation and do all the necessary work up front to avoid any kind of delays, close of escrows, contingency periods, any of those things. I think one of the other things you and I do sometimes, if we if we can't get any information from the management company that we're looking for, we've gone as far as like pulling the recent sales in the building to to see what type of financing those transactions got, so you definitely go above and beyond
We've called other agents who've sold in the building. I know there's actually one in particular, it was a condo that we had sold in Calabasas together, where you had called a lender who had financed a recent sale, and I had called the agent just so we could just try to dig up as much information as we can. And thank goodness we did, because there were some issues with that we were able to get ahead of. Also, you touched on something that was really important, is the contingency periods and timelines. When we're writing offers on behalf of buyers, certainly there's a lot of consultation and education that goes into that process, because buyers really do need to know, what does this offer say? What am I committing to? What am I offering? What am I being obligated to in this offer? And when you're buying a condo or townhome that is subject to an HOA, we do have to take those timelines into consideration, because more often than not, unfortunately, listing agents don't order the HOA docs up front. And sometimes HOAs operate on their sweet little timelines that just don't always cooperate. So, there's a lot of that collaboration with the buyer's agent and the listing agent together, before you write that offer, calling up the listing agent saying, hey, do you have the HOA docs? What do you have? Do you have any disclosures up front? What timelines are we going to need to work with here to make sure that the deal is as enjoyable and pleasurable and smooth for everyone involved? Because it is already kind of like an exciting experience, for both buyers and sellers. Sometimes it can be stressful depending on their situations. And if there's anything that we can do to kind of make it even keel, to make it smooth, it really can make a big difference in the quality of the experience that the client has. So any parting words that you have to share on traditional versus non-traditional? Is there anything that we left out that you think we should cover before we wrap up for today?
I think we covered pretty much everything, but just the only recommendation I have, just doing the due diligence up front, that don't leave that to last minute to find out if there's issues or not, because then we could tackle it from beginning, figure out which lender to go with. Some lenders are more sensitive to certain things than others, and I will do my part to kind of research to see, okay, this condo is going to work with this lender. So we're not wasting time. Once the offer is accepted, we know where we're going to get this client a loan.
Right. Wise words from someone who has helped me close a ton of deals. Thank you so much for everything. For those of you listening, thank you so much again for joining us. I hope you're getting some fantastic value for joining me today. Until next time, take care.